Shy. 5 secret tax breaks your first job HR never told you. I left $2,400 on the table my first year working because no one explained these deductions. My HR orientation was 45 minutes of compliance videos and a stack of forms that might as well have been written in ancient Greek. Not once did anyone mention that I could legally reduce my taxable income by thousands of dollars. I just assumed my employer was handling everything. They weren't. And right now, you're probably making the exact same mistakes I did. Here's what kills me. The IRS literally publishes these deductions. They're not hidden. They're not illegal loopholes. They're sitting right there in plain sight. But nobody teaches you how to use them. Your parents probably don't know about half of them because the tax code changes constantly. Your friends definitely don't know because they're in the same boat you are. And your employer? They have zero incentive to tell you any of this. So today, I'm walking you through 5 tax breaks that could put hundreds or even thousands of dollars back in your pocket this year. And that third one? It's the reason I'm genuinely angry at my 22-year-old self for not knowing about it sooner. But first, let me show you the one deduction that works even if you don't itemize anything. The Saver's Credit is the most overlooked tax break for anyone making under $38,250 as a single filer in 2024. And here's why it's incredible. This isn't a deduction that reduces your taxable income. This is a straight credit that reduces your actual tax bill dollar for dollar. Let me explain the difference because this matters. If you're in the 22% tax bracket and you get a $1,000 deduction, you save $220 in taxes. But if you get a $1,000 credit, you save the full $1,000. Credits are the golden ticket. So here's how this works. If you contribute to a retirement account like a 401k or an IRA, and your income falls below certain thresholds, the government literally gives you money back just for saving. The credit ranges from 10% to 50% of your contribution, up to $2,000. My coworker Sarah started her first job making $34,000 a year. She contributed $2,000 to her 401k because she heard that's what responsible adults do. What she didn't realize until I told her was that she qualified for a 50% Saver's Credit. That's a $1,000 reduction in her tax bill on top of the tax benefits she already got from the 401k contribution itself. She was putting $2,000 into retirement, but only actually losing about $800 from her take-home pay when you factor everything in. And nobody in HR mentioned this. Not once. Now here's where this gets interesting. The next deduction I'm about to show you can stack on top of this one. Most people don't realize you can combine multiple breaks, but stay with me because the math on this is going to surprise you. Student loan interest deduction. You can deduct up to $2,500 in student loan interest every single year, and you don't need to itemize to claim it. That's the part most people miss. You take this deduction even if you're using the standard deduction, which almost everyone with a first job does. Let's run real numbers. Say you're paying $300 a month on your student loans. Over the course of a year, somewhere between $1,800 and $2,200 of that is going toward interest depending on your loan terms. If you're in the 22% tax bracket, deducting $2,000 in interest saves you $440 in taxes. Here's the frustrating part. Your loan servicer sends you a Form 1098-E every January that shows exactly how much interest you paid. It shows up in the mail or in your online account, and most people ignore it or throw it away. That piece of paper is worth hundreds of dollars if you know what to do with it. I talked to my cousin Marcus last tax season. He'd been paying student loans for 3 years and never once claimed this deduction. That's roughly $1,200 in tax savings he just didn't take. And when I asked why, he said he didn't know it existed. His employer certainly never mentioned it. His parents file their taxes differently. Nobody told him. This deduction phases out if you make over $75,000 as a single filer, so grab it while you can. If you're in your first few years of working, you almost certainly qualify. And speaking of deductions that disappear as you earn more, let me tell you about the one that made me genuinely upset with my younger self for not understanding. The traditional IRA deduction might be the most powerful tax tool available to someone in their 20s, and the window to use it effectively is shorter than you think. When you contribute to a traditional IRA, that money comes directly off your taxable income right now, not in 40 years, not when you retire. Right. Here's the situation nobody explains. When you're in your first job, making $45,000 or $55,000, you're in a relatively low tax bracket. But as your career progresses and you start earning $80,000, $100,000, $150,000, that same retirement contribution becomes way less valuable from a tax perspective because of income limits and phase-outs. So the optimal strategy that nobody tells you is to max out traditional IRA contributions in your early career years when you get the full deduction. The 2024 limit is $7,000. If you're in the 22% bracket, that's $1,540 in immediate tax savings. My friend Derek did this starting at age 23. He contributed $6,000 a year for 5 years to a traditional IRA. That's $30,000 in contributions that reduced his taxable income during his lowest earning years. The tax savings alone were over $6,600. And that money? It's been growing tax-deferred for years now. Here's something that ties into this. I've been creating some financial content using AI voice tools lately, and one resource that's actually been useful is 11 Labs at tried11labs.io 2pu101 a2ll1. If you're building a side hustle or creating content around these topics, it's worth checking out. But back to the point. The IRA contribution window closes on tax day of the following year. So right now, you can still make contributions that count toward last year's taxes. That's not a typo. You can reduce last year's tax bill today. And this connects directly to the next two breaks, which I'm going to move through quickly because they're both immediate money savers. Health savings account contributions are triple tax advantaged, which sounds like marketing nonsense until you understand what it actually means. First, contributions are tax deductible. Second, the money grows tax-free. Third, withdrawals for medical expenses are tax-free. Name one other account that does all three. There isn't one. The 2024 contribution limit is $4,150 for individuals with qualifying high-deductible health plans. If your employer offers an HSA and you're not contributing, you're leaving money on the table. Even if you're healthy and never go to the doctor, you can invest that HSA money and let it grow for decades. Many people don't realize you can use HSA funds tax-free for medical expenses when you're 65, or withdraw them for any reason with just a regular income tax penalty. A $4,050 contribution in the 22% bracket saves you $913 in taxes this year. And if your employer offers HSA matching, that's free money you're ignoring. Now the fifth break is different. It's not a deduction. It's a benefit you should be negotiating for. Remote work expense reimbursements are tax-free to you when your employer pays them. But here's the catch that changed after 2017. You can no longer deduct home office expenses as an employee. The deduction only exists for self-employed people now. So what do? You negotiate.